Broadcasting from beautiful, tropical Vero Beach, Florida, it's Money Nation with Ed Gardner.
Good morning. Welcome, everyone. Today we got special guest Joe Cunningham from Worldview Capital on the phone today. Joe, how are you?
Yeah, pretty good, Ed. Thanks for having me. It's always a pleasure.
A couple of interesting topics we're to talk about today, but one of them, I was driving home on the highway from Lake George, and it might have been NPR or something, but they're talking about college and specifically women in college and the percentage of what they make up of college, which I don't know, Joe. I thought it was maybe 50-50, basically, in some of those lines, but they were saying that the women in college in some schools are up to, I think the average was 60% to 40, something like that, or 58 to 62. It's amazing how women are making up a large part of educated graduates. What's your thoughts on that, Joe?
Yeah, well, my thought is it's unfortunate, to be sure. I mean, there almost seems, and I don't mean to get socially, too deep in it, but like a war against men. They really promoted the Title IX and the leveling the playing field for women, and they should have. That was correct. But, I mean, the pendulum swung too far one way and then too far back the other way. So we need to find a balance there. And I'm sure that, I got a son who's 16. This is kind of an opportunity for him because there will be schools that will look at those numbers and say, we've got to bring in, we have to become more attractive to the male that are applying to our universities. So by and large, I'll give you an example. UCLA created 3,000 new slots for students about 2 years ago. 90% were taken up by women. Okay, so they saw there was an issue. They went out and addressed it, and then their solution set just kind of shot themselves in the foot. Didn't achieve what they had hoped to achieve. For me personally, I've all but given up on the elite private schools. They're a fancy handbag in society. They're meaningless. They're not doing their job. They're not getting any traction in terms of the greater societal educational platform. But the state university system, the land-grant schools in particular, your Michigans, Ohio State, Washington, UCLA, those hold great hope for social policy and for, the gender dynamics. It's not just about, your pronoun preference. It's got to be a little bit more gravitas to it. And, it used to be that boys were always in engineering and other such things, and girls were doing something else, English, and that's flipped as well. I mean, the girls are in engineering and pre-med and, the more difficult academic, more rigorous academic disciplines, and the boys are kind of fluffing off a little bit too. So, there's a lot going on there.
Well, they said, like they talked about in the interview, boys are necessarily not always good learners. Some are ADHD. They run around. They don't focus in class and things like that. It's at the same time, you've had this big focus on getting rid of vocational skills in schools. And there was something I was looking at, Nation of Risk. This is back in 1983, and they talked about the perceived decline in academic preparation. American students are scoring low in international scores. But the old thought back then, Joe, was that vocational education in high school deters capable students from college and prepares them for dead-end jobs. Now, I think that's dead wrong. There's a shortage in masons and electricians and plumbers, and if you think about it, 90% of all millionaires in the United States are small business owners. So a lot of those guys who are smart enough have the entrepreneurial, spirit behind them when they go from one truck to 5 or 8 trucks. They become millionaires with a plumbing business, electrical, all kinds of different businesses. So it's interesting how I think they're getting back to that. But I think that's in the last couple of years, there's still been a decline in vocational. They can't find masons, can't find plumbers. Well, what's your thoughts on that, Joe?
Well, it's not just the building trades, but you're absolutely right. My son has a split day. He goes part of the day to regular high school, does 4 classes, and he does the second half of the day at a VOTEC. But his VOTEC is computer science and programming, and that was really what he was interested in. And we felt, okay, well, that sounds like a better use of your time than sitting through, another math class or a study period or something like that. And that really seems to resonate with him. So it's not just the building trades, as it were, but now it's, they've expanded it. Now, I will say that our local community college is recognized as one of the better ones in the community college system, and he'll likely gain some college credits through this program. He's a junior. But it's been interesting for us to see how they've expanded the offering, and how, before there might have been one bus going over that was half full. Now there's two buses going over every day that are full. So people are gravitating towards that. I'd also like to say, Ed, that at the university system, there's a lack of apprenticeships. And as, full disclosure, Ed and I went to the same university, Northeastern University, has a co-op program. Northeastern University's co-op programs get you those internships. They get you prepared for the workplace. Well, we had
a lot of people jobs before they graduated. It worked out well for a lot of people.
Totally. I was a registered broker and worked at Fidelity and Citibank in college. And as you may recall, Ed, certainly the ratio of women to men was less favorable back then when we were brokers in college. So they had to work a little hard. Yeah. So, I think there's going to be a shift in the whole education platform towards that apprenticeship model. It's so famously executed in Germany and some other countries around Europe that get people the skill sets they need, because the other side of that is the employers aren't paying to give you that skill set. The top people get into those training programs and get an opportunity to, get up the curve. There used to be, back in, the 50s and 60s, what we called blue-collar intellectuals, right? These were well-read factory workers and blue-collar workers who were striving to get up into the middle and upper middle class, and they achieved it. That kind of stopped around, in the 80s, and everybody strived to go to a name brand name brand university, because they're about the same thing. And we lost our way. So hopefully we'll find our way back on the side of the angels.
And if you take into consideration cost of college, too, for students who have to pay their own way and take the loans out, you factor all that in versus getting a good job in any type of vocational, working immediately or soon after, and not building up all that debt versus, and then what they end up making down the road and paying the debt back. It's a big burden for a lot of people. And the college education might have done great things for you in the 50s, 60s, 70s, but when everyone had a college education, it doesn't do so much for you. You know what I mean? It does, but when everyone has one, it's not as special, I don't think, and not as helpful. We see a lot of people today trying to get jobs. They have college educations, no jobs. It seems like there's a lot of certain jobs, but not a lot of other jobs.
And that goes to the case against free higher education. Now, you don't want it to have it exorbitantly expensive as it became. And those kids, those Gen Z kids, they got screwed. They just did. While the administration grew and paid themselves, the kids bore the brunt of that, or their parents, or whoever was guaranteeing those loans, right? Right. Now, what they could do, very simply, is they could repeal the 2005 Education Act that made it impossible for these kids to discharge their student debt in bankruptcy, or to even negotiate the student debt to lower rates with their bank. So if you have a student debt now, you can't go to your bank and say, "Oh, look, I'm paying 12.5%. I need a lower rate. The average rate for new cars 4%. Why don't you give me something in between?" You can't do that. So these kids so I put it on the banks as much as I put it on the administration and the colleges, and the taxpayers shouldn't have to bear that burden for bailing out these students. The banks should, because they've been gouging them all along. And that 2005 legislation, that was bank-driven, 100%, and it was bipartisan supported. Democrats and Republicans supported it, and it needs to go away.
It's still out there, you're saying?
Yeah, 100%.
Yeah.
And it doesn't even come up. Now they talk about, forgiveness of debt. But it's not about forgiving the debt. It's about being able to manage your debt. If you went to your bank and you were having trouble making, your house payment, you might get some type of forbearance, right? They'll give you a break for a couple of times. Maybe you can refinance.
Even on federal taxes, they have forgiveness.
Yeah, that's exactly right. But Ed, I wanted just to shift here for a minute to more economics, and I love the education discussion because I'm right in it. My daughter graduated from college this year, thankfully debt-free, and with a new car, I might add. But we're about to experience this with my son. Not so sure he's going to get the car, but we'll see how that goes. Today, we had the CPI data out today, right? And we've been waiting on that month out, and I'm proposing a new drinking game, and I think you'd like this one. So every time you hear the word transitory as it relates to inflation, you take a drink, okay? Your day will go pear-shaped and wobbly very quickly, I assure you, because that's all everybody is talking about is the transitory inflation. Inflation is always transitory. It doesn't just come and go. It moves on. Sometimes it stops because the Fed has tampered demand. Sometimes it stops because the consumers have overspent. Okay, but inflation is going to stop, and this one is going to run its course, and it's going to eventually reach a sunset and start to tamper down. We may or may not have seen a little of that today. The indicators I look at, they've hardly moved since the last time we spoke. Bonds are 1.3%, the 10-year. The 5-year tips, which I follow, are 2.5%. They're all about the same. Dollar, it's been doing okay. The stock market continues to chug along, doesn't it? So yes. What I do is at the end of every month is we look globally at the indices, and particularly the MSCI, which is a global country index of 45 different countries, and you can slice that up in a number of different ways, and it gets a little more nuanced look at what's happening. But the U.S. is still, leading the world to a degree. Europe had a slightly better month in August than the U.S., but year to date, Europe's up 21%, the U.S. is up 20.9%. So, those are big gains, and it certainly makes the case for being fully invested in the stock market. So let's just spin that back around to what's happening with inflation and the bond market, okay?
Joe, let's just hold that thought for 1 second. We're going to take a quick break here.
Sure.
Remember, listeners, any questions at all about your portfolio anytime, you can always feel free to give me an email at edgardner@cutterco.com, or you can always feel free to give me a call at 518-255-8854. We'll be right back.
All opinions expressed by Ed Gardner and or his guests on the Money Nation show are solely Ed Gardner's and or his guests' opinions and do not reflect the opinions of Cutter & Company or any of their affiliates. You should not treat any opinion expressed by Ed Gardner and or guests as a specific inducement to make a particular investment or follow a particular strategy, but only in as an expression of their opinion. Ed Gardner's and his guests' opinions are based on information he considers reliable, but neither Cutter & Company nor affiliates and or subsidies warrant its completeness or accuracy, and it should not be relied upon as such. Always talk to your financial advisor before making such decisions.
Welcome back to Money Nation. Joe, so the inflation number, was it 4%, pretty tame number?
That's right. Well, no. It was we were expecting 4%. We came in just a little bit below that. On the year-on-year number would be 5.3%, which was down, but the monthly inflation number was up 0.3% versus an expected 0.4%. So, splitting hairs a bit, but there you have it.
So what's your feelings about that? The number seems pretty tame, but I think, didn't we hear that rents were up a lot? Rents, people, they moving back to cities, that pushing rents up. So that's the really inflation for people. And rents, what was the rents up? And did you say New York City were up 17%, or was that a nationwide number?
That was a nationwide survey from a builder, and what we saw was as leases ran off, when you go to sign your new lease, you're getting a bit of a sticker shock, and they're going up substantially. So a couple of things, there's a shortage of quality housing, for sure. And as much building as we see, they're still not building them fast enough where they need to be built, say in California or Pennsylvania, New York, wherever that may be. So as those old leases run off through the pandemic and the whole moratorium on evictions and things like that, we're seeing a substantial increase in the new leases. Now that will start to translate through the economy, and it will take some time. So, leases are annual things. You don't sign a new lease every month. So as these things run off, we'll start to see that uptick in expenses. And look, generally speaking, I shop, you shop. Prices seem up a bit. Definitely. Gas is done okay. I think the price of oil is over $70 a barrel, but the price of gas by me is under $3. So that's a little bit of a disconnect. I would have expected it to be a bit higher, but there you have it. So we're starting to see, and you'll see more building, apartment building in particular, to meet that demand and meet the you're in a low interest rate environment, to meet the demand, borrow the money, get the house built or get the apartments built, and make a run of it. So that's going to start to work its way through. And what we saw with the Cleveland Fed, that's a component of the Federal Reserve System, they have an annual inflation rate, and they're pretty rock solid on this. In other words, you can't talk them off the ledge, of 7%. So 7% is quite a bit higher than the Fed target, higher than the 5% year on year. And again, we're comparing a trough year, 2020, with a more normalized year, 2021. So there's some disconnect there.
A little odd of a number, right? So
yeah, it is. A little bit off, but they have a pretty good track record at the Cleveland Fed, and we'll have to see how that goes. But I wanted just to circle back. Before the break, we were talking not just the transitory drinking game, but how that would inflation might translate through the economy to the bond market, and some of these stickier pricing elements, including the housing market and the rental market, for example. So what we'll see, I think, later in the year is the bond markets start to recognize some of these inflationary elements, like rents or general cost increases, and start to react negatively. So when the bond market reacts negatively, it sells off in price and the yield goes up. So right now the yield's at 1.3%. And we could expect to see that start to rise. Now, this can happen very quickly, and it can be almost a bit of a shock. If, say, yields went from, let's say they'd start to perk up to 1.4, 1.5, 1.6, and all of a sudden one Monday in October, let's say, ringing a distant bell, the bond market sells off and yields spike up, the stock market would get creamed, just get hammered. And that day's out there, I think. And it may not be in October, and it may not be in December, but it's coming. We're going to have that Fibonacci 10% correction in equities at some point here by the end of the first quarter, 2022. I believe, anyways. That's what we're looking at. And that's how we feel that some of these elements are going to start to translate through. Because like a lot of people, I've been waiting to buy more equities. And equities, as I just pointed out, they're up 20% this year. Pretty good deal, right? But you keep wondering, where should I get in? What stock should I buy? And that's your expertise, Ed. You're the man for that. But it's sticky out there. Valuations are high. We're just wondering.
Well, let's go for a couple questions for listeners here. I mean, you got rents. It's hard to find a place. You can't find a place in Vero Beach, Florida, especially for the winter. They just come down for January, February, March. There's very, very little inventory. If you want to buy a house, they've shot up so much. What are your thoughts on buying right now in this market, or do you wait? What do you feel? Does Joe Cunningham feel about this?
So if you feel that there's going to be some inflation in the pipeline, you buy equities and you buy a house, you buy property, right? They're your best property for sure is your best insulation from inflation. So what we've seen in the property market obviously is if you're a homeowner, those prices have gone up substantially. They can go higher. Because again, and this goes back 15 years, Harvard did this landmark study in like 2005 that there's going to be a generational shortage of housing, and they were right for a change. So, we're seeing that now, and the builders can't build fast enough, although we have seen the price of lumber come off a little bit recently, which I thought was interesting. Because so that's the market responding to the demand from last year for lumber. And we have seen it come off, the price per board foot, which is how we measure that, which I thought was telling. But we will see more construction, and I think that, again, if you like, and location matters, if you like, or if you believe the inflation scenarios, then, stay in equities and buy a second home.
Right. That sounds like a good idea to me, Joe. That sounds like a good idea to me.
It does to me.
Joe, let's talk about the Quad Summit coming up. You got a big summit
one of my
happening
favorites.
here.
As a geopolitical junkie, this one I think went under the radar. And what's happening, and this relates to Afghanistan as well. So U.S. pulls out of Afghanistan quickly, ugly, but they're out. The U.S. has effectively quit the Middle East. We've had enough falafels. We're done. We're going home. We're pivoting very much to Asia Pacific. So what's happening in the end of the month, September, is there's a summit. Now, they don't call it a summit. They're calling it a meeting. It's a summit between India, Australia, and Japan. So the prime ministers of those three countries are coming over to Washington, and they're going to hash out a strategy to counter what's happening in China, which is interesting because just as they're doing this, China's kind of shooting themselves in the foot, right? So we're working on seeing, what particulars they're going to be, will go into that. But, for sure, part of that will be, the military presence in the U.S. and how the bases are apportioned. And India being kind of the linchpin for the consumer, what can happen internally in India where you have the internal politics in India are always, tricky. And I know India well. To see how they can stimulate consumer-driven demand for Western goods. There's consumer demand in India, but it's for Indian goods. They're not like the Chinese that were aspiring to have a BMW. They have their own make and model. They have the Ambassador, 1950s design. It's a nice one. So that's going to be interesting to see how that fits with going back to the Obama administration, how they were pivoting. You remember that word? Pivoting to Asia. Well, it takes time for, a superpower to pivot. And this is part of that pivot. So that's one of the things I thought was pretty interesting. Just want to stay on the Fed for 1 minute because there is one other aspect that's going on in play here. It's like Jerome Powell, the Fed chairman, is up for reappointment. Usually, his term expires like in February, sometimes late January or early February. But usually, they make that appointment well in advance, so the market has, time to react, and there's a transition period if needed. And it's not clear that Biden's going to reappoint Powell, and I think he's done a pretty good job. I do. And they have a path forward to taper the bond buying program and the mortgages they've been buying. And part of that housing market is that the Fed is just buying the crap out of the housing market. So the bank makes the loan, Fed buys the loan, right? Bank now has more money to make loans. So we'll see. There's the Democrats, the whole left part of the party, the AOC. Did you see her dress last night at the Met Gala? Which has run its course, by the way. That thing is.
I missed that, Joe.
Yeah, she had on her dress embroidered "Tax the Rich." Right? Okay, not helpful. But that Met Gala just needs to go away. It's grotesque at this point. But anyways, that enough of that. So they're angling for somebody that's going to really put money into or policy into climate change. And the way they would do that is the Fed would encourage banks to do carbon audits and to divest from polluting companies and things like that. You get industrial policy, right? So I'd like to see Biden reappoint Powell, and I think he will, because he's a steady hand. And Powell is an interesting character. He was a central bank member in Israel and the United States, which you don't find often. So he's got a global view on these things, and he's a dual citizen, much like I am. But, for my Irish-American citizenship, qualifies me to bartend in both Ireland and the U.S. I can't be a Fed. That's not bad, right? So we'll see how the Biden administration goes with that. But there'll be some in the policy circles and some of these things that I associate with. There'll be pretty heated debate on it. It'll be interesting.
Definitely. Joe, thank you very much for being with us today on Money Nation. Great talking to you as always, and we'll check in. I'm sure very, very shortly, and we'll see how these inflation numbers shake out here over the next couple months, next couple quarters.
Yeah, no, my pleasure, Ed. Thank you for having me, and remember the transitory drinking game.
You've educated us well here today, Joe. Remember, listeners, any questions about your portfolio at all, always feel free to give me a call at 518-255-8854. And you can always email me at edgardner@qatterco.com. Remember, all previous interviews you can go to YouTube and just search YouTube Money Nation. Thanks for everyone for being with us on Money Nation. Have a good day.